Dinesh Likhi, the CMD at Mishra Dhatu Nigam, joining in. Dinesh, morning. In a world where global trade prospects are looking bleak, Midhani is majorly catering to one market, and that's the home market, that's India. Now, we've seen an increase in the number of institutional investors, like my colleague just highlighted, since listing that you've had in your company. What are the growth prospects for Midhani that you've been telling investors and highlighting them?
See, Midhani so far was focusing for making the critical raw material for the high-end market, and they were namely for the strategic sectors like defense and the space and the energy. What we have is three-pronged strategy for the growth. A, continue to capture more and more market of these sectors which are important for us, defense and space and nuclear. But in addition, we are trying to find out the new market, new product which are the new, such as railways, oil and gas, mining. These sectors have showing some interest in our high-end product based on the life cycle assessment of our quality. They are started sourcing some of their critical material from us. The third growth strategy is that we are making new product and for the new market. Recently, we have taken a technology from Bhabha Atomic Research Center for Bhabha Kavach. That product we are launching and technological fine-tuning is going on, and after that we'll be launching certain urban product. In addition, a future material like a carbon fiber, we have developed certain technology. We are going to invest in carbon fiber. So I think that in nutshell, there are three growth strategy. A, retain and increase our existing market share in strategic sectors such as defense, space and nuclear energy. The B, try to get into a normal commercial market like oil and gas and railway and mining with a high-end product with a life cycle costing. And C, develop new product market which are basically based on carbon fibers or tungsten powders or armor products, that type of market. So these are three things I think we are focusing on that, and maybe the financial institutes may be building out the story based on that.
You know, the government has increased their focus towards India for defense procurement. Have you seen a rise in orders from there, since you're talking about focusing more on the defense sector?
See, in the defense sectors, if you see the last 4 years, on an average 240,000 orders have been placed, more than 200 contracts have been signed. Within India also, more than 120,000 contracts have been signed. Now, for us in Midhani, for the material supplier, we have seen the success to make two program which is happening now, and Ordnance Factory Board Dhanush gun has been successfully fired. Now we'll be getting the material requirement for that. So I think an Akash missile and the missile programs also are on, and some of the orders will be for the material will be coming from the sector. So we feel that there is a positive impact of the initiative being taken. Recently under Make in India program, they are giving the preference to the domestic players to the extent of purchase preference. So we are going to get advantage out of that, and we hope the defense sector also with these Make in India push will be getting more and more supply from Midhani. Even in the offset side also, we may expect some of the people, foreign contractors, also will be taking and sourcing the material from Midhani to take the obligations under Make in India program.
What's the tenure or duration of most of your contracts in your order book, and how frequently is pricing being looked at?
See, we have currently about 700 crore orders in our order book, and we also are having contracts between 1 to 2 years, about approximately 2 years, but some of the orders we are procuring the same year and servicing it. So it depends upon 1 to 2 years type of contracts are there, and we are trying to serve on that based on that.
Most metal and commodity prices have cracked. Materials like cobalt, vanadium have actually stayed resilient and risen when it comes to their prices. Are you seeing a rise in costs, and how are you going to safeguard your margins if that's the case?
See, it's a fact that in the international market, because of focus on going to electrical vehicles and some other segment where the cobalt is finding application, including even the mobile manufacturers also protecting their cobalt recovery, we got an impact of cobalt as well as vanadium. Vanadium is also getting application in solar panel. Now, the prices has been doubled, in some cases more than double they have increased. Cobalt, which was at 40 or 30-40, has become now 90 and 900. Vanadium also, which was about $10, $11, has become $18 per pound. Now, what we are doing is, A, we are trying to improve the yield of our product so that reduction happens in the consumption. And B, we are trying to reuse some of the scrap, revert scrap also. And then lastly, not the least, we are trying to work out in 2 years horizons, can we get a technology by which we can get the pure cobalt from our scrap there. So these are the few things we are trying to work out that, because as such cobalt and vanadiums are not present in our country, we need to understand that we have to only reduce or reuse or recycle. These are the three things we can do in order to reduce the dependence. But as such, overall in our pricing, it doesn't have a significant impact because we generally use 7 to 8% cobalt in our alloys.
We understand you're looking at reducing the dependency on Chinese imports, but with key raw materials like tungsten as well as nickel not available in the country, how do you plan to do the same? How do you plan to compensate for that?
See, tungstens as such, our country doesn't have a very rich resource. And to reduce the dependence on China, what we are doing is, along with NMDC, we have signed an MOU. We are scouting some friendly countries where we can take an acquisitions in mine. We have zeroed in one of the mine in Vietnam, and if the mine acquisitions part equity is taken, we will be getting a short supply of tungsten concentrate or ammonia para tungsten, through which we will be making the tungsten powder in India itself. So this is a 2 years plan where the dependence on Chinese imports will be reduced, and we'll be getting from starting from mine to the tungsten powder we can make ourselves. As far as nickel is concerned, apart from Chinese sources, in fact, we are more focusing on European sources through the international companies which are producing nickels in our international market. And that's why we are able to do. And in addition, we are talking about a long-term contract in some of the materials such as nickel, so that the dependency on Chinese imports can be reduced.
Your margins, Dinesh, have been very strong. Q4 saw you posting an EBITDA of about 35% on the margins. Is this kind of growth number sustainable?
See, one has to see that which type of product and product mix we do. In the last quarter of the last 17-18, we were focusing more on a titanium product and having a unique production capability in India as far as we are concerned on titanium and high-end superalloy. And these margins are internationally also are forming up on these titaniums and the cobalt alloy and nickel alloy. So it all depends how the product mix is getting shifted. We are trying to shift more on these alloys which are high margin, high EBITDA margins products such as titanium and superalloy. And we hope that in future also the way oil and gas is responding to these products and some other market like space sector, which is now has been sanctioned recently, a 10,500 crore budgets for 30 launches. So these type of high-end EBITDA margins product will be more and more in demand.
We understand that you also have plans to start an aluminum alloys plant, and that's along with NALCO. What's the investment that you'll be putting in, and if you could tell us a little bit more about the timelines for the same?
See, as far as the aluminum alloys are concerned, the defense as such does not have a significant demand of that aluminum alloy, maybe at best around 7,000-8,000 ton. And the type of this plant will require a demand of more than 70,000, 80,000 ton. So what we are trying to do along with NALCO to assess the real demand, how much is automobile will grow and how much railways and other sector will grow. Based on that detailed project report, we will be working on that. In addition to the demand, the other issue is the technological competencies, and we are trying to scout some technology partner. After the technology partner and demands numbers are formed up, we can decide the equity. Because NALCO is open for a higher equity, we also can be open up for minority equity. But currently, the thinking is that the equity proportions can be decided after firming of the demand, firming of the technology partner, and then we can decide how much NALCO will take and how much Midhani will take. Investment is expected to be more than 3,500 crore. The land has been acquired near Krishnapatnam Port, the Nellore district, and some groundwork has started on the land surveys and other things have started now. So maybe within 2 years or so, the clarity will come in terms of the start of the project, and maybe we will be doing in phase manner. The part project will start maybe after 2.5 years, and the full phase will be happening after 3 years.
All right. Mr. Likhi, thanks very much for taking out the time to speak with us so candidly about your business plans. I think what the stock has done is reflective of the market's confidence in your business and its prospects.